your expectation for the Federal Reserve today?
75 basis points, and it's not over there. We see two 50 basis point hikes coming up in July and September, and then the committee slowing down to a 25 basis point hike per meeting until you get to a terminal funds at 3.25%, 3.5% by early next year. So taking this in total, we're looking at a total of 300 basis points of hikes by the Fed in 2022. And here they really need to move into a moderately restrictive territory. I do see that you will see more talk about just that trade-off between growth and inflation, just given where inflation has been printing.
Do you think most of that move is, and does your bond team, Joyce, believe that most of that move is already priced into bonds? The reason I ask is kind of the same question I asked Tom Porcelli of RBC earlier, which is if our viewers hear like, oh, the Fed's going to raise rates by 2% more, does that mean that mortgage rates are going to go to 8%? But if it's already priced in, the borrowing costs of our viewers for their things may not go up as much. Where do you stand on the bond market?
I mean, look, I think there's a lot that is priced in here, but we're neutral on duration right now. And one thing I would just say is that you're going to be in the situation of overshoots, in part because just the market liquidity is really poor right now. And we're seeing this across the major markets. But it's not March 2020 for the market liquidity at the apex of the pandemic, but it's probably 30% below where we were pre-pandemic on the liquidity. But the concerns about moving into moderately restrictive territory, we're going to have to see how the labor market reacts. We're going to have to see what those trade-offs are as far as getting inflation to settle. So I don't think that even though it's priced, these fears are going to go away.
Yeah, no. And by the way, let's talk about Europe if you can, Joyce. I know that the news is new, an unscheduled meeting of the European Central Bank. The reports are that they want to talk about some of the moves in the bond market in Europe. We talked about Italian government debt. You got an early take on that meeting. Unscheduled meetings for central banks, not really ever looked at positively.
Yeah, I mean, look, the ECB hawkishness is catching up with the Fed. I mean, the ECB has taken up its inflation projections notably higher for 2023, for 2024, even while they have lowered the growth projections. So I think the speed of this has prompted the emergency meeting. I mean, they are clearly behind the curve since they have not moved yet. So I think that it is just like, what is the right pace? We had been looking at 125 basis points of tightening before year end, but are they really going to have to move, more than that, given where inflation has been printing? So I think that this is across the board what we're seeing. The markets are running well ahead of a lot of the guidance that has been out there as we look across the developed market central banks, and in emerging markets also, we see more hiking ahead from Brazil, 50 basis points.
What's somewhat, I guess, disconcerting would be the nice word, Joyce, is that all this inflation is happening as China remains not under lockdowns necessarily, but Shanghai, Beijing, some of the ports, they've been operating at very low levels. China air traffic, I just saw some data from China Eastern. It was down like 82% year over year. What's going to happen with global commodities, the price of oil, the price of food, the price of whatever, if and when China fully reopens and starts running their economy full steam? I mean, it seems hard to comprehend.
Well, some of the manufacturing and industrial numbers that just came out for China are looking better. So I think you are probably past the darkest part of the slowdown in China. But we continue to see more upside pressure, on energy prices, and we're still talking about how the ban on oil will be implemented in Europe, in addition to the reopening, the peak driving season, as well. I mean, we're looking at gas probably going to $6.20 at the pump in the U.S. by August. So I think that, we're going to still see some of these pressures, feeding through to the inflation numbers, as well. And that's not even to mention some of the food security issues that also have really been plaguing many parts of the world.
Yeah. And sadly likely to get worse as well. I don't even know if electricity inflation is priced into that. But let's go back to what you just said, $6.20 a gallon nationally. That's JP Morgan's estimate, because if that's the case, that could mean like $7.50 to $8 in parts of California.
Well, we've already moved past $5, and the peak driving season, really is this period that runs up until Labor Day. And so a lot of what is, reflected in that forecast is, the refining capacity and some of the constraints on that. It's not so much that, the move in, Brent going higher as it is, gas at the pump, given some of the constraints that we're seeing. So I do think that's going to play out. The vacation season, peaks. That's also a period in August where you also have poor market liquidity. So, the way the market is set up, I'm not so sure you're going to see the volatility really diminish here, even though a lot is already priced in.
We got a couple 100,000 people in Ohio that are not watching right now, Joyce, because they can't, because their power company forced them to turn the power off. It was a forced blackout by AEP to try to protect the grid. I bring this up because utility costs are going up, electricity is going up. You just mentioned gasoline going up. That's $150 to fill up a 22-gallon gas tank at $6.50, roughly, something like that. How does the consumer survive through that, Joyce? Have wage gains been enough to make up for that? I can't see it.
Well, I think it's the excess savings that have been accumulated during this crisis and during the pandemic, during all of the stimulus. I mean, there is still a buffer right now. One thing that's been surprising has been the resilience that we've seen at the household and the corporate level. But by the end of this year, Brian, we do think that you're going to be back to the long-term averages for savings, that we had before the pandemic. So you've had this buffer that's been put into place, but you're going to be really, and that has supported the consumer spending and that disconnect between what we've seen in consumer spending and consumer confidence, which are going in the opposite direction. But at what point are we so concerned about the slowing of growth that the excess savings, rather than spending it, households will choose to actually continue to keep a cushion